I have to say, this is, I got a little nervous when I heard about this, Phil, saying that you're going to shut the portfolio down, but it's because you're retiring it and starting a new one. So give us some history here.
Well, I mean, well, look, exactly what you said at the beginning of the show. We are at the top of an epic, epic run in the markets. And if you're not going to cash out when you've made ridiculous amounts of money, when are you going to take the money off the table? So it's a good time, especially for a portfolio like this, which is very low touch. We only adjust quarterly when we're on the show. I don't want to take a chance going into the winter, going into the elections and everything else. We don't know what's going to happen. So best to take the money off the table. And it's a lot. It's 300. We're up 381% since November of 2019. So that's 5 years. So about 70%, 76% per year on the average of gains. And we're not sure going forward enough to risk what is now a $400,000 portfolio. I mean, that's really what it's about. And this is true for anybody who has huge gains in a portfolio. Take it off the table once in a while. Reduce your risk by simply putting the money into something steady and safe. That's a good way to run your portfolios. We're not going to miss out too much. We're going to start with a brand new $100,000 portfolio and start populating it right away. And it's great for new traders also. So now people who feel like they missed out on the first run that we did, which started 5 years ago, we can now start and demonstrate how to build a portfolio, how to select stocks, how to use options, that kind of stuff. So I think it's a great fresh start.
Yeah, it is a great fresh start. So it's exciting. And so thank you for providing all that insight for us over the past 5 years, Phil. And we're looking forward to the next one. And it's interesting too, because when we go through the picks, this is one that's more purpose-built for, I think, for a little more volatility, which, you're going to talk about, I think, in terms of some of the things that you have in there. So, and by the way, if you want to get more details on that, just take a look on the screen here. You can see, let me point to it right there. You go, Phil Stock World, Money Talk Portfolio. You can get all the details of what's happening there. Okay. Let's start with, you've got 1, 2, 3, 4, 5 pieces we're going to talk about the portfolio today. And the first one is gold. So tell us why gold, and then we'll talk about the specific trade.
Well, why gold? Now, gold being Barrick Gold, it's always very confusing, but gold is Barrick Gold, which is the world's largest miner. And when you buy a gold miner, you're buying gold, but instead of buying a lump of gold and putting it somewhere, you're buying a company that that already owns 76 million ounces of gold in the ground. So that's one thing, and so that's leverage. So when the price of gold goes up, all their gold gets more valuable, and the company makes more money mining and selling the gold. And if gold doesn't go up, doesn't go down, then you still own a business that mines gold and produces and sells gold, which makes a profit on a regular basis. So why would I want to buy a lump of gold when I could buy a company that creates gold? It's a huge difference. I think people should always buy things like this.
Yeah, one that makes you money and one that just sits there. Yes, for sure. Okay, let's talk about the actual play itself here. I'm going to bring up the board so people can see the actual trade, Phil, and maybe you can take us through it.
Oh, fantastic. Okay, so yeah. As we like to do with most stocks when we start off small, we like to sell some puts because I'm saying I like this company. They're trading at about $20 now, and we're going to sell 5 of the $20 puts for $350. That puts $1,750 in our pocket, and then we're going to use that money to put towards purchasing a bull call spread where we buy 20 of the December 2026 17 calls, and we sell 20 of the December 26, 22 calls. So it's a $5 spread, and that's going to net us in at $2,550. And it's a spread that's already $6,000 in the money, and it's a $10,000 spread. So if Barrick Gold goes up, or if Barrick Gold goes up to 22 over the next 17 months, we're going to make a profit of $7,450. I mean, that's fantastic. That's what, 292%.
It's not a bad return. And my standard question, Phil, I always ask you, the risk in this one is that you're going to own Barrick Gold.
Correct. Selling the puts is an obligation that you take on, saying, I will buy Barrick Gold between now, and you're giving the obligation to make you buy it to the person who's selling you the contract. I will buy Barrick Gold for $20 a share between now and January 2026. So at any time, they have the right to make you buy it for $20. Obviously, if Barrett Gold goes down to $10, you still have to buy it for 20. You'll take a $10 loss, which in this case would be about $5,000. We
Yeah.
don't think that's likely, and it's really no worse than if you own the stock and the stock goes down. So I love selling puts. It's a fantastic thing to do.
All right, all right. And people just listen, that's the risk, as Phil stated. So you got to make sure you have the capital to be able to kind of get in and
Oh, absolutely.
complete that obligation if that happens, and always doing research. Let's get to the next one. Barclays, BCS. Take us through the thesis and then the trade.
Sure. I just want to say, though, on what you just said, never, ever sell a put on a stock that you don't really want to buy for that price. If you don't really want to buy it for that price, what's going to happen is if there's a downturn like we just had, you'll panic and then try to get out at the wrong time, and you won't hold your position, and it ends up being a worst case scenario.
Yeah.
So don't mess around. Don't say you're going to buy something if you don't mean it.
And I also
Anyway,
will just
so
say, people,
Barclays.
to your point, I'm just going to say, know your risk tolerance. That's really important in all of this stuff.
Mm-hmm.
Yeah, yeah. Okay, go ahead
Right.
with Barclays.
So Barclays, we love this because Barclays is down at $11, $12, somewhere in that range. And here we're going to sell 20 of the $12 puts of the January 2026 $12 puts. That generates 35. That puts 3,500 in our pocket for promising to buy it. And don't forget that if you take it by itself, we're promising to buy 2,000 shares of Barclay at $12. They're giving us $1.75. So our net entry is $10.25. So that's quite a bit below where Barclays is now. That's the worst thing that can happen to us is we buy Barclays at a discount. We're using that money that they give us up front, and we're going to then buy ourselves 40 of the 2026 10-12 spreads, 10-12 narrow margin spreads. And Barclays is already at 12, so it's all in the money. And it's an $8,000 spread that we're buying for a net of $500 out of pocket. So we're spending $500 cash, and we have the obligation to buy 2,000 shares of Barclays at 12, which is $24,000. A lot of people mistake the fact that there's a risk factor, that you say, oh, my risk is owning Barclays for $24,000. But unless it goes to zero, you're not going to lose $24,000. If it drops 20%, you're going to lose 20% of 24,000, which is $4,800.
Right.
The risk isn't all of what it seems. That's the thing about these things. People get very nervous.
Yeah, and the same thing is, it's just you're owning Barclays, but again, you have to have the capital to put up to buy should that actually come to pass, and you have to be comfortable with what will be happening there.
And we have what we call allocation blocks in our portfolio. So a $100,000 portfolio usually has about $200,000 of buying power, and that means we'll take 10 allocation blocks of 20,000 each. And so we maintain an expectation that we could spend about $20,000 per block, and that's how we manage our risk. So no single block is going to kill us,
right?
But and the risk is manageable within each one if the market starts to fall.
I got it. We have time. I'm going to let people know who are listening. And again, they can go to your website, see the MoneyTalk portfolio. We're going to put up the link. So we've done gold, we've done Barrick Gold, we've done Barclays, we've got Invesco, Nokia, and IMAX. And we can't do all three right now, but I'm just going to tell people those are them. So give me one more. You get to choose Invesco, Nokia, or IMAX.
Oh, God, they're all good. Certainly Invesco. I think people need to understand Invesco.
Let's do that one. Tell us about that then.
Invesco is an ETF marketer. So there's not a lot of risk in their business model other than maybe people won't buy ETFs because that's what they do. They make all their commissions on all the people who are buying ETFs. And it's a very simple play for us. We're selling 10 of the $20 puts of the 2026s. And we're buying the 15-20 spreads. And Invesco is, I think, 16 something right now. So it's a little bit aggressive, but we think they're tremendously undervalued. And so we're spending net $1,750 on a $10,000 spread. So that's $8,250 upside, which is 471% upside to the cash in 17 months. So it's an aggressive call sale because we think it's very undervalued. And the worst case here for us is owning 1,000 shares of Invesco. And by the way, when you own the shares, if we get forced to own the shares, we sell more puts and calls against it and lower the price even further.
Yeah.
So even on a long-term plan, it's a great, it works out very well.
And again, I know I'm repeating myself, and I apologize ad nauseum, but again,
No, risk isn't. Yeah.
You got to know, you got to be ready to kind of pick up those shares if the obligation comes to you, and that's just something that people have to be ready to do and do their own research. Get comfortable with what's happening, right?
Yeah, absolutely.